What is growth investing?
I think it's the assumption that irrespective of the price of something now, it's going higher. So you better get involved now. In other words, it's a sector of the economy as represented by particular shares, which seem to be doing well on a roll, attracting lots of news flow, attracting lots of money inflows, and that those share prices are going to go even higher. So you can contradict the two with each other. You can have a little argument, get the two people going, and your mate Adrian and I have had some good spats on air of late. But in some senses, there's a bit of overlap, because it's all about guessing about what's going to happen in the future, isn't it?
But then, to me, I would assume that you guys then have, if you're a growth investor, have the more sorry, Adrian, I don't want to upset you here, have the more difficult job, because Adrian and his crew can sit down and historically look at a company and say, yeah, we're going to get some good stuff out of this. But you guys have got to look at the company and go, we think that in the future, this is going to go places.
Look, Adrian's thesis is that you've got a company which for one reason or another has fallen off the bus. You know, it's a little bit broken, the management has fallen out of favor with the market, or maybe the business model just came a little unglued for a while. It was a particularly tough drawdown, but that it's fundamentally sound and that it's going to rebound, and that you should get in now while everybody else is too scared, too chicken, too idiot not to see the opportunity. He doesn't like stocks that have done very well recently. So he wouldn't be keen to buy a technology share that's coming off a 5-year run into some new market. Mm-hmm. He wouldn't like a pharmaceutical stock that's flying because it's invented something new. Where I have a problem with him is that some of those beaten down opportunities are going to stay beaten down forever because their business models are broken, or because they're being eaten by global competitors. Mm-hmm. And it's the difference, it's knowing the difference that's not as easy as it looks. Conversely, we all know that there have been many wonderful success stories in business which look like they're too expensive for decades because they just go on from strength to strength to strength. So I think you can begin to understand that you can't be a slavish, buy anything that's broken or buy anything that's on a trot. You have to apply your mind to what's going on underneath it all.
But then how do you go about assessing the potential of a company?
Look, it's tricky, because if we all knew what was going to be big in a decade's time,
we wouldn't be sitting here. We'd be doing this show from
the beach,
a boat in Monaco.
Exactly, because you would have just said, oh, well, you know, cell phones are going to be big, back when they weren't. Yeah. And you would have loaded up with shares in MTN and Vodacom and Nokia and Apple, when they were all, you know, tiny companies that nobody really knew anything about. The other thing you'd be able to do is identify, you know, quite mature sectors of the economy where some company was just emerging as an interesting young player and that was going to capture market share. And it was going to do something a little different and become a major player. But unfortunately, you know, there's no trick to investing other than making fairly low risk, high probability bets and hoping for the best in sections of the market or sections of the economy which look like they have slightly better than average prospects.
Now, you see, you and I are not the same sort of investor, because I can't take money and say probability. I shrink from that.
But look, the probability thing is not as scary as it sounds, because if you look at what's going on around you in the economy, you can see that there are trends, and you've just got to slow down a little bit and try and see the wood for the trees, so to speak. I mean, let me give you a couple of practical examples. Typewriters were once a great business.
Okay, well, I thought you were going to say typewriters. That's what you should be investing in. And when that happened, I was going to say, thank you for being with us. We're going to wrap the show up right now, because we're going to do an outside broadcast from Tara with this man on the screen.
Typewriters have been Photochrome, you know, a film camera was once a wonderful business. Going back a little bit further, transistor radios used to be the most exciting technology available. Things change, things move on. Sometimes you have to just slow down and look at it. But let me say to you, for example, that mobile telephony and the ability to connect to the internet via your mobile phone or via a 3G dongle like you've got on this computer in front of you, that's a business that's going to attract lots of influx of capital in years to come. Conversely, my view anyway, things like cigarettes What chance do cigarettes have of being a big, thriving, flourishing industry?
I think you and Rupert would take a bit of...
So for me, it's completely self-evident. You don't buy the one that looks like it's running out of road.
So you wouldn't buy BAT?
Definitely not.
Really?
Absolutely not. And I would neither buy Sappi. You know, Adrian loves Sappi. I think he does. Because he thinks, look, this is a company that's got great pulp, paper, factories, blah, blah, blah. It's just having a bit of a rough patch. They bought some, you know, fine paper businesses in Europe and the US, and now it's just, you know, they're a bit oversupplied.
But in your opinion, the paper business is going down because we're moving to a paperless society.
Exactly. Adobe Reader on your PC, which you use to look at documents, you email them, you send them backwards and forwards. People are reading more online, etc.
My wife's got one of those,
Kindles, book
those
readers, etc. Exactly. So, you know, they don't need that stuff to do anymore. You can get the newspaper on your computer. What do you need a pile of them, you know, filling up your garage for? So I would argue that you've got to identify those kind of big trends and go where the business flow is going. Adrian would say, no, you're a little bit kind of bleeding edge. You run the risk of overpaying all the time for things. I say nonsense. You know, as long as you position yourself well and you take a long-term view, it's the only way to make money in the markets.
So you sit there and it's a lot of it's a personal opinion. To be honest, it's an individual opinion on
But it always
something.
is. It always is, because those guys that say, you know, Telkom's having a bit of a bad patch, but it's coming back, what do they know about the future? It's always their opinion. They think, oh, well, because it's done badly, it's got the potential to rebound, but what if it doesn't? And what if it goes on having a bad time for the next 10 years? But everybody's always guessing. Yeah, everybody's guessing.
But to me, it just sounds like a more of a lonely sort of space. Are you a lonely person, Paul?
You know, not at all. The fact is, as far as I'm concerned, all the right people agree with me. And those that don't, I don't pay any attention to them.
Does this change, this let's call it a trend, okay? Does it change from company to company within an industry, within a sector?
And we get it wrong. I must say we get it wrong. I mean, a couple of years ago in our US portfolios, we were deeply in love with Nokia. We thought, look, this is a company that's got so much open road ahead of it. It's an absolute no-brainer. Regrettably, what's happened is that they've had no smartphone top-end model for like 3 years, during which time their lunch has been eaten by Apple, and the Android phones that HTC and Samsung and all the Koreans are producing better and better every year. So you can get it wrong. Sometimes the big theme is right, but the company that you've selected is wrong. But, you know, I guess what I should put on the table here is that this kind of growth style investing works best when you're prepared to take a long run view and when you're not going to get frightened out of stuff easily. The worst form of growth investing is where you get involved what's called momentum trading, where you really only are buying the stock that's gone up by 5 or 10 or 15% in the last couple of weeks. Because then it would seem to me you are cruising for a bruising. In other words, you're trying to short-term time the market using what's hot at the moment. I think there's a subtle but important difference.
What do you mean by short-term time? So you want to buy into something just for
I'm sure you've had a couple of Muppets on the show here from these banks that talk about technical trading and charts that look as though they're going to kind of give you a short-term gain, etc.
Funnily enough, there's an email that's come in about that, about technical analysis and fundamental analysis.
These oaks, they drive me mad because they'll say, oh, look, it's hit a resistance level, or it's kind of, you know, approaching a support level, or it's been a strong momentum influx. A lot of people are looking for short-term advantage in the stock market. So they're looking for situations where companies had some good numbers, earnings have beaten expectations, and they think, hey, now's my opportunity. I'm going to jump on this pony and see if it can take me a little bit further. That kind of thing often ends badly. What I'm saying is slightly different. I'm saying don't worry so much about what the share price is, because on balance that reflects the, you know, buyers and sellers and where they're exchanging hands. Look at what's going on in the underlying economy and in the sector of the economy that you're finding attractive, and then look for the best vehicle to play it. Don't get drawn into this whole thing about market timing and buying hot stocks. You know, there have been plenty of times where there's some kind of bubble or enthusiasm thing going on. We know that in the late 90s there was that whole dot-com thing where anything that had a dot-com in it was attracting a lot of attention. In 2005, 2006, there were a lot of small construction companies listing in our market. And there was a lot of building going on, and so people thought, you know, I can make this money next year and that money the year after. That's the thing to avoid.
So do you essentially look at what's happening in the economy and then look at what sectors will benefit from that in the economy, and then start looking at companies within those sectors who you think would be able to deliver to the economy what its needs are.
Exactly, and there are words to describe that methodology, which is called so-called top-down. So people look at top-down, are those that go from the macro environment to the sectoral and then look at the companies. The value investor tends to be the opposite. They look at the bottom-up. So they look for companies that are trading at a significant discount to their net asset value, or they look at the cash on the balance sheet, or they look at historic earnings trends and other kind of technical factors. I come back to the point that I made earlier, though. Everybody's always guessing about the future. How do we know what's going to happen really in the future? All of us are just taking educated guesses. For me, I'd rather be trying to proceed from some kind of broad model of what's going on with humankind and the global economy, rather than just looking at, ratios and financial formula.